Thank you.
Hi guys, good afternoon.
Hello, everyone.
Carl is the only one we're missing. He might be just a few minutes late, but we can go ahead and get started if you're ready.
Perfect. Good evening, everyone, and welcome. For those of you who would like to stand for the Pledge of Allegiance, please do so now.
Pledge allegiance to the republic for which it stands, and one nation, under God, indivisible, with liberty and justice.
Justice for all.
Oh, maestro. What did he say?
Terrific. We're good, Melina?
Yeah, we're good. It's a work session, so we don't need to do roll call. All trustees are present except for Representative Schiffer and staff. So we're good to go.
And we can vote on this agenda item in a work session?
I believe so. Since it's an emergency, I think that's fine.
Perfect. All right. Well, then let's move forward with our work session. Then we don't need to do any, we don't need to open it up to public comment either, do we?
No, I mean, that's up to you. We don't, you can if you'd like, but.
Is there anyone in the audience? I don't see anybody.
Oh. No.
Nope. Okay, perfect. Let's move on to agenda one. Agenda one is resolution 2026-15, a resolution establishing stage 2 municipal fire restrictions for the town of Silverton. Elizabeth.
Yes. Given ongoing fire activity in the region and entering a period of extreme fire danger that's forecast for the week of, or July 1st through July 5th, we're putting forward a resolution to go into stage 2 fire restrictions. And we have Jim Donovan here, who's prepped this memo for us. And have anything you'd like to add?
Really, the only thing to add is that all the jurisdictions surrounding us are in stage 2. Forest Service is going into stage 2 Thursday, and then BLM, talk to BLM at the commissioners meeting, and most likely Wednesday night, they will be in stage 2. So it's good alignment along jurisdictions, and the memo just describes all of the kind of the objective information. So myself and Sheriff Lawrence are here to answer any questions.
Well, I don't have a question, but Jim, I want to say thank you for all you're doing.
Thank you, Jim. All right. Great, thank you.
Jim.
All right, thank you much. Any discussion from the board? Without any discussion, make a motion to approve resolution. I need a motion to approve resolution 2026-15, a resolution establishing stage 2 municipal fire restrictions.
So moved.
I'll second.
Fantastic. All right, roll call, please.
Yes.
Rush.
Yes.
Yes.
Trustee Wakefield.
Yes.
Trustee Johnson? Yes. Mayor Harper.
Yes, thank you so much. Motion passed unanimous. Everyone be safe out there. Agenda item number 2. This is the fun one. The 2025 financial audit report. We have Lorraine Trotter and Jim Hinkle
Coming.
of Hinkle and Company CPA.
Can you hear me? Good. Okay, great. My name is Jim Hinkle, and I'm going to start off all of this with a discussion about the audit process. And then Lorraine is going to follow up with more of a detailed analysis of the actual financial statements. So we started our audit by updating our understanding and documentation of the town's internal accounting controls. We specifically are looking for segregation of duties. Transaction typically takes 3 steps: the initiation, the approval, and the recording of that transaction. And we do not want one person to do all 3 steps. We look at the cash receipts, the cash disbursements, and the payroll cycles, all independent of each other. And then throughout the audit process, we test what we call control features, or the invoices approved before payment, or the invoices supported by proper documentation, etc. And we do this for a couple of reasons. The first reason is that we are looking for what we call significant deficiencies or material weaknesses in the internal control structure. A significant deficiency is defined as a design flaw in the system of internal accounting controls that would allow an error to go undetected in the ordinary course of business. And a material weakness would be a significant deficiency that might result in material misstatement to the financial statements. And based upon our analysis and our review and our work, we did not find any significant deficiencies or material weaknesses in the internal control structure. That's the answer that you're looking for. We then take that information and we use that to design our audit tests and procedures. We primarily use what we call test of details, which is pretty much what it sounds like. We drill down into account balances, we look at the underlying transactions, and we compare those to source documents to ensure that they are accounted for under general accepted accounting principles. The end result is the audit opinion, and your opinion is an unmodified opinion. And in layman's terms, that's a clean opinion. States that the financial statements have been prepared in accordance with general accepted accounting principles. And that's also the answer that you're looking for. After the draft is approved tonight, we will issue the final. And with that, we will issue a required communication letter. We are required to communicate in writing if certain events occur in the course of the audit. And we have nothing negative to say in that letter. We did not have any difficulties in the course of the audit. We did not have any disagreements with management. And we did not have any audit adjustments where we found errors in the books and records where we thought we needed to make adjustments to be in accordance with general accepted accounting principles. So all in all, the audit went smooth. We also felt like we had open transparency. So we felt like we could ask for and receive whatever we needed, and nothing was kept from us in the course of the audit process. So all in all, it went smooth, it went good, and your audit is effectively finished, and you are ready for another year.
That's terrific. Thank you so much.
And with that, for numbers, I will turn it over to Lorraine.
Thank you, Jim, and hello, Mayor Harper and everyone. I'm sorry I couldn't be there in person tonight. I took Elizabeth up on her offer to just appear by Zoom based on the fires and the travel restrictions and the time constraints that might be involved. But I enjoyed coming out last year, and I enjoy coming, so I'll hope to do that again next year, if not sooner. I'm going to share my screen and go through the financial statements with you. As you know, oops, let me find this. I've usually open, for those of you who've been on the board for a while, I open by saying that I think that the requirement, the duty that you have as trustees to safeguard the assets of the town is probably your most important duty. And so knowing what's in your audited financial statements and how that pertains to your upcoming budget decisions, I think is a real important thing for you to know. So I'll kind of walk you through this audit, and my goal is to make you feel that you understand what's in there. And if you wish to, you can delve in further. You can ask any questions tonight, or you can feel like that satisfies you and you can put it aside and feel like you've accomplished your duty as trustees to safeguard the assets of the town. In the audit itself, can you see my shared screen at this point?
Yeah.
Yes. Okay. There's introductory pages, and I'm sorry, I have to modify my screen a little and get to the pages. There we go. And the auditor's report is one of the first things that comes up. And as Jim mentioned, he gives you this clean opinion in the second paragraph, saying that in his opinion, the financial statements present fairly in all material respects the financial position of all the aspects of the town. So that is very nice to see. And it's common, so it's not like it's a shock, but we're very glad to see it each time. Then comes the management's discussion and analysis. And this can be a cheat sheet for you to use if someone follows up with you after this meeting and says, oh, I saw you got the annual audit. How is the financial position of the town? You could list off some of these bullet points to a student or someone that asks that's in the community, a reporter if they ever ask. And also you can refer to this if you're issuing debt and you've got a bond rater or someone of that nature that wants to know about your financial position, they would be looking at this. But these financial highlights show that the town of Silverton had a net position of over 9 million at the end of 2025, and that it increased substantially during 2025 by 2.8 million, almost 45%. Now, a lot of that was due to the loans that you're getting and for your major projects in the sewer, et cetera. But the town's governmental funds reported also ending fund balances of over 2.2 million. And this was a good increase from the year before. And that had to do more with the housing authority grants that you've been getting. So that has helped to increase your net position. The general fund increased its fund balance by 416,000, which is wonderful. We talked a lot about fund balance in the past, and that's the money that you have left over at the end of a year and what you're starting in the next year with. And you want to make sure you have enough of that to keep things going if there's ever a major emergency. The net position of the sewer fund I listed here in the financial highlights, it increased by over $1 million due to the capital grants received. And then the water fund increased its net position also because of a capital grant, but the refuse fund decreased its net position due to an ongoing operating loss. So we'll talk about that in a minute. The next information here talks about how governmental funds are accounted for and how they're addressed and viewed. And essentially here in Silverton, you have two types of governmental funds. There are three general overall types. You have two of them. One is the governmental funds that are accounted for based on fund balances. Money in, money out. It's financial resources. How are you going to keep operations going in the general fund, the streets, the police activities, the things of that nature that a town has to do from year to year? Are you collecting enough taxes to support that or too much? And do you have what you need to make sure that happens no matter what else goes on in your community? The proprietary funds are run like a business, and they're based not on the flow of financial resources, but general economic resources, including your capital plant, your treatment plant, your pipes in the ground, et cetera, infrastructure. And so these funds, you're not based on taxes, they're based on actually selling the goods or services, the water or the sewer treatment that's needed to run those operations, the trash services. Elsewhere in the book, there's notes that explain a lot about how the town does business and what the financial various terms mean that you'll see in the report. Also, there's budgetary schedules, which are what you're more used to looking at from month to month, that show how things are going compared to that year's budget. So here in the MD&A is a condensed statement of your net position. A net position is your bottom line that the town has gotten to over the entirety of its existence. From the time it was started until now, you have amassed net position in the governmental funds, the ones that are supported by taxes for ongoing operations of governmental nature, of $6 million. And you can see that last year, 24, it went up, it was 4.4 million. So again, a lot of those grants in the housing operations are helping to increase your net position. Also, some of your decisions that you made during the budget process for expenditures and revenues have contributed to that increase. The business type activities, water, sewer, and trash, have also gone up, mostly because of grants, and they've got about 2.9 million in net position. But you'll see that most of that is in capital assets. That's the pipes in the ground and the treatment plants. It's not spendable assets. So up above, you've got some current assets, which are cash and receivables from your billings, but you have an unrestricted balance of 5.9 million. Over in the governmentals, you have 1.4 million. And so there's more information here about how those net positions should be viewed as to what you can use, but 68.2% of the total net position, if you add the governmental and business together, it's in the town's investment in capital assets. You also have some restrictions on certain funds. Certain things have to be used for certain purposes, special revenue funds, Mullis Lake Park monies, state shared revenues from Conservation Trust Fund for Parks and Recreation, certain your cemetery revenues, and a certain amount for emergencies should they arise. This next table, changes in net position, just shows what happened in these years that are shown, not overall time what you've amassed. During 2025, you had program revenues in the governmental activities where you actually charge someone for the service they were receiving, like a building permit or various fees for using your facilities or your campground, etc. And then under that are general revenues that come from taxes. So you can see that you did get a capital grant that was for the housing, or you've got a few, but capital grants totaling $1 million. And that was the big increase there from year to year between the governmental activities. These other taxes come in through shared revenues from the state. These are not directly what you charge people, but it's what the taxes support. That's the bulk of your revenues in these governmental activities. They go to support these various program expenses. And we did add community development as a program to keep track of that separately. In the past, it had been folded into public works or administration, mostly administration. So we decided at this point with the development projects that you've got going on, and it's a good time to separate that out into its own program. But your total expenses went down during the year. So you did curb your expenditures while your revenues went up. And that contributed to that big increase down here of $1.6 million to take your beginning fund balance from the 4.490 that it ended last year with to the 111,000 in 25. When you look at the business type activities, you see that almost all their revenues are from these charges for services because you're billing your customers for water and sewer services and trash. And then you have some from capital grants related to those operations. You have almost nothing from general revenues from taxes, which is normal and expected. And that's why the business type activities are shown separately, because they are run on a different basis. Here, your program expense groups are the water, sewer, and refuse disposal. And again, you did go from $1,697,000 in 24, increasing by $1,200,000 in 25 to get to that $2.9 million there. The next part talks about a little bit of the reasons why these things went up, which I just kind of highlighted as we talked, but they're listed there for you as well. And then there's some charts and graphs, if you appreciate that, that show like the percentages that come from the various sources. So for the governmental activities, you read the legend on here starting at noon. So this starting at noon, the first one, charges for services, is blue. About a quarter of your revenues come from charges for services. Down here in the green, you got major capital grants that particular year of 25. But most of your operations, your revenue, come from on the left side of this, from about 5:30 on up to 11 o'clock, is the sales and use taxes and property taxes. So as for most towns, you are dependent on sales taxes and property taxes to run your general operations. And they're shown down here, the difference between program revenues and expenses. So your expenses in almost every area are higher than what you get from program revenues. The big difference is on the community development, where you have those grants that are for the actual programs that you're running. The next page shows you for your business type activities. Let me get this centered a little better, sorry. That your charges for services increased by $295,000 during 2025. That's really good. We talked a lot about the need to raise your rates for your water and sewer operations in particular, and also refuse. And you've made a big difference here, and we'll see what your net income is and what your bottom line is and how it's trending and how you need to keep doing this to stay where you need to be for future costs and capital, but to just make sure that your operating revenues cover your expenditures. And so you see here for water, your revenues did cover your expenditures, your program revenues for that program. For sewer, they did, and a lot of that is the loan for sewer improvements. But refuse did not. So your revenues are below your expenditures in that refuse fund. There's more information that's similar about each of the major funds. There's certain requirements to be termed a major fund. And here you have the general fund, and it's very similar to what we talked about for all of the funds together. But here you'll see it doesn't have all those grants that the housing and the Anvil townhomes have. It has mostly taxes here in the blue section. That's your major revenue there. Anvil Townhomes has these balances that we'll look at in a minute in the chart form. And the Housing Authority is also a major fund this year. And then your water and sewer funds are major funds. The the refuse fund is not a major fund, but I don't want it to be ignored. And we are going to look at that on the pages that follow. There's also information about the capital assets and debt administration of the town, which are big dollar values very often. And these are mentioned here as far as the projects that you had during the year and some of the grants that you got. And then that kind of wraps up the management's discussion and analysis. These next two pages, the statement of net position is exactly what we just saw the condensed version of. So it has more lines of detail here. We already talked about this. Also the statement of activities about how the various activities have program revenues, charges for services, etc., as well as general revenues down here, the sales and the use taxes, etc. But this is what you're more used to thinking of is the various funds that you see in your financial statements each month.
Mhm.
This is the balance sheet for the governmental funds. And then on the next page is the statement of revenues, expenditures, and changes in fund balance. And this is how you mostly will be evaluating what's happening in the town, as far as what revenues coming in, what expenditures are going out, and where does that leave us? So for the general fund, you have all these taxes and a few charges for services and fines and fees. You have this outgoing amount. You have a an excess of revenues over expenditures because you did curb some of your expenditures during the year and you got some big revenues. And so at the bottom, you'll see that your fund balance at the beginning of the year was 926,000. You added 416 grand to it. So your fund balance for the general fund is over $1 million now, $1,342,000. And what I'd like to point out is this is your operating fund. You have to provide for general government, public safety, certain public works and community development event activities, regardless of what happens. Someone comes in and needs a building inspection, you have to do it. You need to provide public safety. You could cut back on recreation and culture if there was a calamity and you were short on cash, and same with special events. But most of this you have to provide as a town. So you want to say, how big should your fund balance be? Do you have enough in your fund balance to keep doing that if you did have something wipe out your tax base, like a fire or a flood or something? Each year you're getting in almost $4 million in these revenues. And so if your tax base was really hurt during the year and you weren't getting any sales taxes for a while and you didn't have FEMA money coming in yet, but you still had to provide these services under the expenditures, you want to make sure you have enough cushion here in your ending fund balance to keep going until such time as the tax base is rebuilt and or you get emergency help. So 1.3 million isn't the whole amount of what your annual revenues are, but it's several months worth, and it's a good chunk of what your sales tax, your taxes from property, etc. are. But as you go forward, that's something to always think about. How big do you want your fund balance to be? Do you want a whole year's worth of revenues? Do you want half a year's worth of revenues sitting in your fund balance? Because if you lose those revenues, how are you going to fund these expenditures? The other funds besides the general fund aren't so critical in that regard. But you can pause projects especially, construction projects in the Anvil Townhomes Fund or the Housing Authority Fund. But, once you get things up and running with these various projects, they will have to be operated. But at this point, it's not as critical to have a fund balance, and they're low. You only have about 30 grand in the Anvil Townhomes project. It kind of goes grant and expenditure. So you're not trying to amass enough to keep operating for a year. But in the Housing Authority, you have about 400,000. A lot of that is transferred to the Anvil Townhomes project. So you see these transfers of 663,000 into one out of the other, just because of the way the town receives those grants through the Housing Authority. But you're in pretty good shape, and I'm glad to see these improving fund balances in each of these funds. The top of this page showed other governmental funds, and those are the non-major funds, and we'll glance at those in a minute. First, we're going to move on to the proprietary funds, and again, these amounts are going to be for your water, sewer, and the refuse collection. They're very similar to what we saw in the proprietary funds in the management's discussion and analysis, but they were all combined together there. So here we see each fund. The refuse fund is non-major, but water and sewer had charges for services of decent amounts, operating expenses, and they had a net income. last year they didn't all have a net income, so your needed rate increases have made a difference here. The refuse fund, however, still has charges for services in the $250,000 range, but expenses over $300,000. So a net operating loss there. Aside from operating, you get some capital or operating grants, aside from what you're charging people. But these you really shouldn't rely on to run your operations. You want your operating income to run your operations. These are for special things. When you see that you have a net position of $1.3 million in water and $1.6 million in sewer, that's good, but most of that sewer came from these grants and it's going to be spent on capital. It's going to go back away. And then for water, that doesn't probably get you very far when it comes time to have to replace or expand or renew your treatment plant. I believe the town may have been spending certain capital contributions in the past because they don't seem to have a lot in the fund balance. And whatever time that plant or the pipes need to be replaced, you might get grants, you might not. You want to have a fund balance there so that you are running an operation that is looking forward and that you're planning on replacing your plant and equipment when you need to. This refuse fund net income, the net loss, has added to what the loss of the fund was at the beginning of the year. So that really needs to be the focus of your decisions about what charges for services need to be, or what services need to be provided and how they're provided, so that you don't keep operating at a loss on the refuse collection. Aside, that's the crux of things, but just briefly, I'll show you what's in the notes. There's a lot of discussion here about the reporting entity, which is the town, and you don't include a fire authority or other things that people might ask, is that part of the town? So it defines your reporting entity. And then it talks about those government-wide versus fund statements. We just looked at both types, and there are a few differences. Talks about what you're measuring on the governmental funds with the money in, money out versus the economic capital plant of the proprietary funds, water and sewer and refuse. Talks about which funds are major funds and what they do. And also talks about the non-major funds. There's 3 in the general fund, in the governmental activities. There's information about your capital assets, what you capitalize when, and how you go about that. There's information about your long-term obligations and how you look at your fund balances, how you collect property taxes, how you budget, what the town is allowed to invest in. And this is your statutory town, so this is what the statutes would allow you to invest in. So if people are saying, why don't you, buy Amazon stock or whatever, you can say, we have limits on what we can invest in, but you're using a really good vehicle for investing, which is the local government investment pool, Colo Trust. And it exists for small towns or big cities to pool their money and get higher rates of return than they could on their own. And it doesn't require any finger on the pulse of the investments like it would if you were the city of Denver and investing your own money. So it's a really good option, and the more money you can keep in Colo Trust as opposed to sitting in local banks, the more interest earnings that you will have. Here's a summary of your capital. Sorry, I'm having trouble moving this a little bit. Here we go. Of your capital assets and how they change during the year. First, there shows for the governmental activities, and it's grouped by land versus buildings, furniture, machinery, equipment, vehicles, and the accumulated depreciation over time and what their net value is. In your fund statements, that doesn't show because we're just measuring money in, money out. But on those first statements that were in the MD&A, that this was added in as part of the investment and capital assets that we talked about. But during the year, you had construction in progress for the housing projects of 2.3 million. The next page shows the business type activities, capital assets. And there was some construction in process there for your sewer project. And then you've got building improvements and machinery and equipment. And you've always shown your plants as part of buildings and improvements and your lines. Long-term debt is shown. Most of your long-term debt is in these leases for various types of capital equipment. But now you do have, starting in this additions column, these big loans with the First Southwest Bank that's for these the housing projects. Those will be refinanced at some point, but that is a big increase in your debt this year. There's more information about each of your outstanding debts and when they're due and what the debt service to maturity is. So you can really delve into that and what the terms of the various loans are and how they work, if you want more information on that. Then there's the business type activities, and here you pretty much you have this long-term loan with the Colorado Water Resources and Power Development Authority. And then now you have this loan for the sewer project that will be refinanced into USDA bonds when the project's done. But that's a big addition to your balance. It went from just a small 200 and some thousand to over 2 million during 2025. Again, information about each of those loans. There's a lot of information about your retirement commitments, and then any risk pools that you're belonging to for your insurance coverage. If there's any litigation, that would impact the reader's viewpoint of your financial position, it would have been listed here. You've got certain intergovernmental agreements that are described here, and you can delve into those to see how you're dependent or helping other jurisdictions. Then the back of the book shows your budgetary schedules and what was budgeted for each fund and where you came out so that you know you were in compliance with your budgets and didn't exceed them. And it also shows your fund balances at year end. Here's your Annville townhomes, same thing, each budget and the actual, and housing authority. In the back are the three non-major funds that I mentioned. So you've got a conservation trust fund. These are shared revenues from the lottery proceeds that the state sends out based on a formula. I think it's based on population. You've got about 90,000 there. And then you've got Molas Lake. And again, this is overall time. You have amassed 90,000 in conservation trust funds, about $500,000 in the Molas Lake Park Fund, and about 61,000 in your cemetery fund. And as far as the last year's use of, additions or changes in that, you've got the conservation trust fund money comes in around this amount every year. And you've adopted a policy of not just spending it as you go, you're kind of saving it up so that if you have a park project in the future, you've got a nest egg there that you can use for it. It could also be used for park maintenance if you ever needed to, but that just kind of fritters it away instead of having those charges in the general fund where they are now. Here's your Molas Park. It's making a good increase in fund balance and building up, like I said, almost $500,000. It added 133,000 during 2025. And your cemetery fund has got some fees and no big expenses, no expenses during 25. This information about your budgets and being in compliance with those for these three minor non-major funds. And then you've got your budgetary comparison schedules for your water fund, sewer fund, and refuse fund. That's essentially your financial picture. There's a form here required to be put in that talks about highway funding and what was used for various highway projects, including maintenance, patrol, traffic, etc. during the year. With that, I'm happy to answer any questions, and I hope that you feel like you have a good idea of what's in here and what matters to you, and that we can answer questions now or in the future, or you can look into it more on your own, or feel like you've accomplished our goal tonight.
Well, Lorraine, thank you so much. I look forward to receiving a copy of this and getting to dig deep or deeper. The goal of this board is to set up future boards in the community on a better footing, to make sure that the town and future boards have more success, greater success. So this is all great information. And I see Chris with his hand up. Chris, fire away.
I just had a quick question on like best practices of ending fund balance percentage, whether it be the general fund or those other funds, but probably most importantly, the general fund. I know you mentioned it's kind of up to us to kind of decide what we think that is, but I don't know, based on your experience, do you have a recommendation on, percentage of, amount of months to pay or a percentage of overall revenues that we should keep on hand? Thank you.
Yes, thank you. I think the smaller the town, the more you should have in your fund balance as far as a percentage of 1 year's revenues. If you don't have tornadoes there like we do on the Front Range here, but you have a tornado hit Aurora, it might take out, a 3% of its tax base. But if a tornado drops down and hits, Burlington or something, you could wipe out the whole tax base in one night. So Burlington should have a bigger percentage in its fund balance than Aurora needs. So similarly, if you have an event that could suddenly be catastrophic in a very short time and take out all of Main Street's sales taxes or property values here around the whole town, then you're going to need more money to keep things going in the general fund until then. So if you could move toward a year and that's palatable to you, keep moving toward it. As I said, you would get some state help, but sometimes that's a while in coming, or federal help. And then you do want to be able to help your town rebuild, and you might have some additional costs because of that. So if you could move toward that without overtaxing your people, then that would be the direction to go. I wouldn't lower the fund balance without a really good reason. I'd keep trying to build it.
Yeah, and I might add, I've typically, because we do a lot of work all over the state with municipalities, and we typically see anywhere from 6 months worth to about a year and a half is the typical. Anything less than 6 months is really pretty small amount. Anything over a year and a half is probably hard to justify to the tax base while you're sitting on so much cash. So somewhere in that half a year, 6 months to a year and a half would probably be, what we typically see in most towns and small cities throughout the state. So that kind of gives you an idea of kind of where you sit compared to the average, if you will.
Melina, don't we have a financial policy that states how much we need to have in reserves? Yeah, 6 months.
Right now, our policy is
Just a quick add-on question on that. Are there restrictions if the net fund that's available is divided among different funds where we can't actually use certain funds in that emergency situation?
Well, and that fund balance is just the general fund. That doesn't include the water, sewer, and refuse, because we can't use those funds for anything other than water, sewer, and refuse. So that's the general fund balance is that 6 month mark.
That's mostly correct. That's why you do have separate funds, because they need to be accounted for their uses. You could transfer some money from one of those enterprise funds to the general fund. That's allowed, but you don't have a lot extra in those funds either. the reason you have the separate Mullis Park and the separate Conservation Trust Fund is those are restricted revenues that have to only be used for why they were received. So showing them in a separate fund instead of blending them in and trying to keep track of that some other way in the general fund is the reason why you're supposed to have separate funds that clearly show that those restricted funds are being used for their designated purposes.
And we can only do one transfer a year, right? If we needed to do a transfer, or I thought that we can only do one transfer, otherwise it loses the enterprise fund status.
It actually works the other way. Is if you transfer money into that fund from general revenues and you exceed 10% of total revenues, then it can no longer be treated as an enterprise for Tabor purposes, which means you have to have an election if you're going to issue any debt. It also means you have to have an emergency reserve established per Tabor. And so you want to avoid putting general revenues like taxes or any transfer from general fund in the enterprise funds, but it can go the other way.
Okay, that makes sense.
Could you make just a quick comment on the, our long-term debt position and where you sort of feel that is in a risk scenario?
I don't really have any qualms about it. The reason that you have that debt is for good reasons to build these capital projects. Especially in the enterprise funds. When it comes to housing, that's always harder because you're going to need revenue from the housing project to pay off that debt. And there's often pressure to not charge very much for those projects and not to have the revenue stream you need to pay that debt back. There's pressure on the water and sewer bills too. But I think you have to raise your rates and you have to provide, because that's a basic service that needs to be paid for by the users. So I don't know, maybe Jim has some comments on that.
Yeah, as far as the debt level is concerned, as long as you have the cash flow to meet the debt service requirements, you don't want to be too narrow on there. If you have cash flow that what we call cash flow before debt service of 1.5 to 2 times debt service, so that you've got enough cash flow to be able to meet that debt service needs, then that's where you want to be. Generally speaking, the bond underwriters will be looking at that and they'll make that decision that you've got the cash flow to be able to cover that debt service, so they won't give you the loan.
It's really important to keep that in mind when you think about your rates, though, because you're thinking it's normal to think now about, oh, this is what our operations cost and this is what we charge. Oh, we got these grants, we got these loans, we're building this capital project. But then you have to start paying those loans back. So you need more revenue to pay those back.
Is there aside from the cash flow component that is essential, is there a general number in terms of carrying long-term debt in a town of our size that you would hesitate against, or is it just strictly based on cash flow?
I'm not familiar with any kind of standard number. It all varies depending upon how much deferred maintenance you have that you've got to fund through debt, how much growth the town may be having that you have to fund the expansion of services. So there really isn't a average or a number that one might look at in that regard. It's primarily the cash flow to be able to service the debt service, the principal and interest payments that you have.
Yeah. Thanks.
Well, does anyone else have any questions or comments for Jim and Lorraine?
I had a question. So one of the things that we've had struggles with in the past is administration fees being charged to enterprise accounts. And it seems like that's in a better place this year. Am I reading that correctly?
I'm not knowing what you mean by in a better place, but it is customary to charge for the services of your staff that benefit those enterprise funds.
Mhm. Okay.
I think it has to pretty much pass what they used to call the reasonable man test. You know, if you were charging 90% of your costs to those funds, that reasonable person probably wouldn't say, gosh, that seems fair. But
Yeah.
if you're charging a third, and that's about the time that's spent by the various staff, if you've got a little chart that shows, yeah, it's half of her salary, it's, you know, a quarter of theirs, etc., that helps.
And that's what it seems like we got into a better like proportion for the administration fees, right? To those funds is what it looks like. Okay. And then I did notice, because I think when I saw the significant increase, it was like the fees and services. And then I went there and it mostly looks like that's coming from the street impact fee, right from the EPA trucks. And so I think we saw a significant increase just because they were moving so much, but we probably don't expect that, right? In
I
next
wouldn't
years.
see that number being consistent. It
You
depends.
do?
No, I don't. see
Oh,
it
yeah.
Consistent. I mean, if it's entirely dependent on what they're doing,
Yeah,
you know, if they don't have a big project in a summer, then we probably won't see those.
yeah.
those fees collected, but if they do have a project, then we will.
Well, that's what I'm assuming most of it is from that 177,000 is from the EPA trucks. Yeah, because we have the exemptions.
Mhm.
And just note, for our 2026 numbers, we are ahead of, anticipated revenue from that.
I think
yes.
we are ahead for this year, what we budgeted. I think we're already ahead.
Cool.
So.
That's sweet.
Lindsay, I appreciate that question. One of the points that Dana, our DOLA representative, had for us was where we were at and where we felt we needed to be. And he had made the point that we, as a community, should really think about getting back to pre-COVID numbers as far as a lot of our expenditures. And I know some of those things we can't do. Some I think we possibly could. Lorraine, what are your thoughts on that?
Well, the inflation that came down during the Biden administration essentially was, it's just really going to be hard to ever get back to rates and expenditures that are lower than that. The inflation's slowing down, so that's good. Fuel is going down again, so that's good. But pre-COVID numbers, that's just like saying, I don't know, any number from the last decade that you should be at those levels. It just doesn't really happen that way. I would look more at your revenues versus expenditures and see if there's a trend in the gap widening or lowering.
Yeah, the other thing you have to keep in mind with that too is the growth within the town, to the extent there is growth, and the additional services that have to be provided for that growth. And so, just kind of a blanket statement of going back to pre-COVID levels has an awful lot of variables that would come into play that would make that difficult.
Mm-hmm.
I think that's the answer I wanted to hear.
Okay.
Thank you so much. Well, there's some things we can do and there's some things we can't. We just have to recognize that.
One of the good things for COVID for small towns is that people started ordering goods delivered to their houses instead of driving to a neighboring city and spending the money there and paying those sales taxes. So the small towns that used to drive elsewhere to do a lot of shopping kind of quit doing that so much. And so sales taxes have increased in towns like Silverton.
Mm-hmm.
One more question on the, like how much money we should have in reserves, because we have, I think, a policy for our general fund. Do we have a policy for our enterprise funds? Are you allowed to do that? Like if I'm thinking about like emergency services, like it's water sewer.
No, I'm not sure. I'm not sure what our policy says specifically. I think it's just specific to the general fund, but I'm also not certain if that's.
Yeah. I guess then, Lorraine, is that like, that's maybe the question is that typical to see enterprise funds like water sewer have reserves in that, like emergency reserves?
Yeah, and in that case, you know, the thing you're looking forward, obviously you want operating income to show you're getting enough. You're probably going to keep getting those revenues. It's not quite the same tax-based calamity that could happen, but you want to have enough, you want to have a plan for what it's going to cost to replace your plants or to expand them or redo them, and how many years between now and when that's probably going to need to happen. And make sure that, and if you can be building up your net position, your fund balances there essentially to cover, if not all, you know, a significant portion of that, then that would be how I would look at the extra money in those funds that you want to start to amass.
Oh,
There are more grants available for that type of thing, but they're never guaranteed.
yeah.
And they're not 100%. You're going to have to shell out when you have to replace a plant.
Ron, did you have anything over there?
Holly, Ron?
Good, Jim.
Don't have anything.
You could also
Good.
borrow money. Let me add to that. When you replace a plant, you want to pay off the old loan from the old bonds before that happens, and then, you know, bond again if you wanted to for a new plant. So that's also an option there. But that's the focus I would have on those operations for water and sewer.
Chris, you have any additional questions? All right, we got a big thumbs up. I don't think I have any additional questions. Anything from staff?
No questions from staff? It is nice to, over the last almost 5 years, watch our water and sewer, at least they are not in the red anymore. They were very, very, very deep in red, so you can just get the refuse fund.
Working
Or I know, or,
Working on
I know, our do one step at a time, part-time. Refuse and code enforcement officer has already made significant visible progress in the last week. Having a town employee up there it's gonna work. Maybe next year when we do this, we'll be in the black.
What? Wild.
Crazy.
It's all about the baby steps and really getting everyone to pay into the system. I think for water and sewer, you've seen a certain segment of the population carry the water for a really long time. And I think it's with these new water meters and having them implemented and working, you'll see everyone start to pay in.
Yep.
And then you'll see those balances go way up. It's a
Yep.
good thing.
An improvement in that with refuse just in the last week.
Yep. I like it. Well, Lorraine, Jim, I don't have anything else. And it appears the rest of the board does not either. And staff does not. And I want to thank you guys for your time and for your dedication to Silverton and all you do for us.
Well, thank you for your time tonight and appreciate being able to share some insights.
You're welcome. Thank you for your interest and your attention. We appreciate that.
Yeah. And then we will get a copy soon enough.
Yeah, I just forwarded you a copy of this draft, Jim, and then when we get the final version, that'll get sent to everybody and to the state.
Thank you. I know I kept asking. I'm sorry. Thank you.
Welcome. Thank you.
Thank you.
Good night.
All righty, guys. Well, terrific. Well, that went well. We're doing okay. Any discussion from the board?
No.
Wow. I can't see everyone, so you guys need to speak up.
That's why I said it.
I'd say it's like a pretty clean bill of health, other than
Good.
freaking refuse, but
We have to look at the most recent, how are we doing this year so far?
yeah.
And sort of compare that now.
Right.
Yeah.
And yeah, we'll be diving headfirst into the budget season here and taking a very thorough, detailed look at those expenditures versus anticipated revenue and
I budget a lot more.
Well, I know again that there's some things that we can cut and some things we really do need to look at. And other things are a part of just being a governing body. And we have to provide services and there's no way to cut those. So I think we're doing well. And I think this new approach of being ultra fiscally responsible, I think is going to pay dividends in the long run.
Yeah.
And I really appreciate everyone's help on this. Setting up Silverton for long-term success.
Great work to staff for being really working well with their team again. Sounds like that went well. Lorraine's awesome. I have her in the back of my head every time we had to raise rates or
I will say
think about cutting.
this year was the easiest audit that I've done.
Nice.
This year was really, really, really simple. They sent me one big list. I sent them everything to their portal and I didn't really hear anything back for a while. I was like, are we good? Do you need anything? They're like, yeah, we got it. I'm like, great.
Yes.
Well, I do before we go and conclude this evening, I do want to give a shout out to Carl. He's been watching on YouTube. And so Carl, thanks for your dedication, man. We appreciate you.
YouTube from the river.
He's YouTubing from the river. I don't have anything else. I don't believe anyone else has anything. And seeing that the time is 6:31, I think we can conclude this meeting.
Thanks, Jim.
Thank you, Jim.
Thanks, Jim.
Thank you all very much.
Bye, Jen.